Insurance claims management and claims disputes, processes, challenges, and best practices. The Solomon Fadun, Risk Management of Everything channel, presents Insurance claims management and claims disputes, processes, challenges, and best practices. Welcome to the Solomon Fadun, Risk Management of Everything channel. On this channel, you will see videos on risk management and its application to diverse areas and sectors. If you are new here, subscribe to our channel and press the notification button to be notified when we upload new videos. Thank you. This video will help you to understand the meaning of insurance contract, insurance claims management process, the challenges insurers face in handling claims, the causes and types of claims disputes, the principles and policy conditions on insurance claims, the mechanisms for resolving disputes, including negotiation, mediation, arbitration, and litigation, the best practices for improving claims efficiency and reducing disputes, and practical insights and examples relevant to insurance markets globally. By the end of this video, you will have a clear understanding of how claims management drives value in insurance and how effective dispute resolution can protect both insurers and policyholders. Now, let's begin. Introduction. Insurance is only as good as its claims process. This statement captures the essence of the entire insurance value proposition. No matter how attractive a policy may appear at the point of sale, the true test of an insurer comes at the moment of truth, when a claim is made. If claims are handled efficiently, fairly, and transparently, confidence in the insurance system is strengthened. However, when claims are delayed, denied unjustly, or poorly managed, trust erodes rapidly, often leading to disputes and reputational damage. Insurance claims management is the end-to-end process by which an insurer receives, assesses, processes, and settles claims made by policyholders. It encompasses several technical and operational activities, including claim notification and registration, investigation and loss assessment, policy coverage verification, claims evaluation and decision-making, and settlement and closure of claims. At its core, claims management is about delivering on the insurer's contractual promise while maintaining efficiency, accuracy, and fairness. Claims disputes may arise during claims processing. A claims dispute arises when there is a disagreement between the insurer and the policyholder, or beneficiary, regarding the outcome of a claim. This disagreement may relate to 1. Whether the claim is valid, coverage dispute, 2. The amount payable, quantum dispute, 3. Responsibility or liability, and 4. Interpretation of policy terms and exclusions. Claims disputes are not merely operational issues, they often escalate into legal, financial, and reputational risks if not properly managed. Insurance contract. A contract is a legally binding agreement between two or more parties whereby rights are acquired by one or more parties to act, or forbearances are imposed on the part of the other. Insurance is a contract between two parties, the insured and the insurer, whereby the insurer undertakes to make good a loss suffered by the insured caused by specified perils during the contract period, in exchange for consideration known as the premium. Insurance is the pooling of fortuitous losses by transferring such risks to insurers, who agree to indemnify insureds for such losses, provide other pecuniary benefits on their occurrence, or render services connected with the risk. Individuals, households, and businesses can purchase insurance policies to manage their risk exposures. All proposed risks are assessed by the insurer to ensure that each insured pays a commensurate premium and that appropriate terms and conditions are included in the insurance policy. Hence, insurance may be viewed as the custodian or treasurer of the fund. Insurers undertake or promise to indemnify or compensate insureds in the event of a loss covered by the insurance policy in exchange for premium payment. Insurers are expected to make good the insured's loss in accordance with the terms and conditions of the insurance contract. It is, therefore, essential for insurers to have a sound claims management system. Insurance claims. An insurance claim is a formal request by an insurance policyholder to an insurance company for indemnification or compensation for a loss, based on the terms and conditions of the insurance contract. The insurance company will review the claim to ensure its validity and then pay the insured or requesting party, on behalf of the insured, subject to the terms and conditions of the policy. Insurers know that a good claims handling system will deliver tangible results for both commercial and personal lines. Hence, to keep pace with the challenging market environment and competition, insurers should, 1. Invest in transforming their in-house core claims legacy systems, 2. Cultivate data analytic capabilities, and 3. Improve customer relationships across all touchpoints. The non-life insurance industry is witnessing shifting trends in policy administration and claims, the two core functions of insurance. The claims process is the defining moment in a non-life insurance customer relationship. To retain and grow market share and to improve customer acquisition and retention rates, insurers are focused on enhancing the customer claims experience. In a highly competitive insurance market, differentiation through new, more effective claims management practices is one of the most important ways to maintain market share and profitability. Insurers can transform claims processing by leveraging modern claims systems that are integrated with robust business intelligence, document, and content management systems. This will enhance the efficiency and effectiveness of claims processing. It can benefit insurers both operationally and strategically by enabling them to reduce claims costs, improve their combined ratio, enhance claims processing efficiency, and drive customer retention and acquisition. Importance of claims management. Here is the importance of claims management. 1. Trust and confidence. Trust is the foundation of the insurance business. Policyholders pay premiums with the expectation that they will be compensated in the event of a loss. A well-functioning claims process reinforces this trust, while poor claims handling can permanently damage the insurer's credibility. 2. Customer retention and satisfaction. Claims experience is the most critical area in the customer journey. Efficient claims handling leads to higher satisfaction and customer loyalty. However, poor claims experience leads to dissatisfaction, policy lapses, and negative word of mouth. In highly competitive insurance markets, retention is often more valuable than acquisition, and claims management plays a decisive role. 3. Regulatory compliance. Insurance is a highly regulated industry. In jurisdictions like Nigeria, regulatory bodies such as the National Insurance Commission, NICOM, set standards for claims settlement timelines, fair treatment of policyholders, and transparency and disclosure. Failure to comply can result in financial penalties, license restrictions, and reputational sanctions. Hence, effective claims management is not only a business necessity but also a regulatory obligation. Insurance claims management. Insurance claims management is the systematic, coordinated process by which an insurer handles policyholder claims, from the moment a loss is reported through final settlement and closure. It is a structured, coordinated process by which an insurer fulfills its contractual obligation to compensate a policyholder after a loss occurs. It begins at the point where the insured notifies the insurer of an incident and continues through investigation, evaluation, decision-making, and ultimately settlement or denial of the claim. Beyond its procedural dimension, claims management is also a critical component of enterprise risk management within insurance institutions, as it directly influences loss ratios, operational efficiency, and customer perception. Objectives of insurance claims management. The objectives of insurance claims management are multidimensional, and often involve balancing competing priorities. A well-designed claims management system seeks to achieve the following. 1. Timely settlement. Insurers are expected to settle claims promptly to meet customer expectations and regulatory timelines. This ensures that policyholders are treated equitably, while insurers avoid overpayment. Claims should be processed and paid within reasonable and regulated timeframes. Delays can increase customer dissatisfaction and regulatory exposure. 2. Fairness and accuracy. Insurers must ensure that each claim is assessed accurately and fairly, strictly in accordance with the terms and conditions of the policy contract. Claims decisions must reflect policy terms and conditions, actual loss incurred, and legal and contractual obligations. This requires a careful evaluation of coverage, verification of the cause and extent of loss, and determination of liability where applicable. 3. Fraud detection and prevention. Insurers must remain vigilant against fraudulent claims, which can significantly erode profitability and distort pricing structures across the market. Insurance fraud is a major challenge globally. Claims management systems aim to identify suspicious patterns, investigate inconsistencies, and prevent fraudulent payouts. This protects the insurer's financial stability and honest policyholders. 4. Cost efficiency. Effective claims management, therefore, seeks to minimize leakages, control operational costs, and enhance efficiency without compromising service quality. Effective claims management balances minimizing operational costs, avoiding leakage, overpayment or fraud, and maintaining service quality. 5. Customer satisfaction. Equally important is maintaining customer satisfaction, as the claims experience often shapes the policyholder's overall perception of the insurer. The claims experience is often the most critical moment of truth in insurance. A seamless process enhances customer trust, brand reputation, and retention rates. 6. Regulatory compliance. Claims must be handled in accordance with regulatory standards set by authorities, including settlement timelines, disclosure requirements, and fair treatment of customers. In regulated markets, including the insurance industry, these objectives are further reinforced by compliance requirements set by supervisory authorities such as the National Insurance Commission, NICOM, which mandates fair treatment of policyholders, transparency in claims handling, and adherence to prescribed settlement timelines. Key stakeholders in claims management. The process of managing insurance claims involves several key stakeholders whose roles are interconnected. The key stakeholders include the policyholder, the insurer, insurance brokers/agents, the loss adjuster, third parties, and regulators. 1. Policyholder, insured. The policyholder refers to the individual or organization that purchased the insurance policy. The insured is responsible for reporting the loss promptly and providing accurate documentation. The policyholder, or insured, is central to the process, as they are responsible for initiating the claim by reporting the loss and providing the necessary documentation to substantiate it. Their experience largely determines satisfaction and trust. Their level of cooperation and understanding of policy terms can significantly influence the efficiency of the process. 2. Insurer, insurance company. The insurer, as the risk-bearing entity, is responsible for evaluating the claim and making the final decision regarding payment. The insurer is responsible for assessing and settling claims. The key responsibilities include evaluating coverage, investigating claims, and making claims settlement decisions. The insurer must balance customer service with financial prudence. The insurer must balance its fiduciary responsibility to shareholders with its contractual obligation to policyholders. 3. Insurance broker/agent. Intermediaries such as insurance brokers or agents often act as facilitators, helping clients navigate the claims process, interpret policy provisions, and communicate effectively with the insurer. Brokers often play a critical role in reducing misunderstandings and disputes. Insurance brokers and agents act as intermediaries between the insurer and the policyholder. Their roles include assisting in claims notification, advising clients on documentation, and facilitating communication. 4. Loss adjuster, claims adjuster. A loss adjuster is an independent or in-house expert appointed by an insurer to investigate the cause of loss, assess the extent of damage, and recommend claim amounts. Their technical assessment is central to objective decision-making. In more complex cases, loss adjusters or claims adjusters are engaged to conduct independent assessments of the loss, determine causation, and recommend appropriate compensation. Their technical expertise is particularly valuable in large or contentious claims. 5. Third parties. Third parties such as repairers, medical providers, and legal professionals may be involved, depending on the nature of the claim, especially in areas like motor, health, and liability insurance. They are particularly relevant in liability and motor insurance claims. 6. Regulators. Oversight is provided by regulatory authorities, which ensures that all participants operate within established legal and ethical standards, thereby safeguarding consumer interests and maintaining market stability. Regulators oversee the market conduct, claims practices, and consumer protection. Insurance regulatory authorities, including Prudential Regulation Authority, PRA, and Financial Conduct Authority, FCA, in the United Kingdom, the Office of the Superintendent of Financial Institutions, OSFI, in Canada, notably the National Insurance Commission, NICOM, in Nigeria, the Central Financial Commission, CFC, in China, and the National Insurance Commission, NIC, in Ghana. They ensure that insurers operate within legal and ethical boundaries. Types of insurance claims. Insurance claims vary depending on the type of policy. Insurance claims can be broadly categorized by the type of policy under which they arise, and this classification has important implications for their management. Insurance claims can generally be classified into two categories, life and non-life. 1. Life insurance claims. Life insurance claims are typically more straightforward and are often driven by documentation rather than extensive investigation. These include death claims, in which benefits are paid to beneficiaries upon the insured's death, maturity claims, which are settled when a policy reaches its contractual term, and surrender claims, in which the policyholder opts to terminate the policy before maturity. These claims are usually document-driven and less complex to investigate. 2. General, non-life, insurance claims. In contrast, general insurance claims, also referred to as non-life claims, tend to be more frequent and operationally complex. Motor insurance claims, for instance, may involve vehicle damage, theft, or third-party liability, often requiring physical inspection and repair estimates. Property insurance claims may arise from risks such as fire, flood, or burglary and typically necessitate detailed loss assessment and valuation. Health insurance claims involve reimbursement or direct payment for medical expenses and require coordination with healthcare providers and verification of treatment eligibility under the policy. Liability insurance claims are perhaps the most complex, as they involve legal responsibility for harm caused to third parties and may escalate into litigation if disputes arise. Each category of claims presents unique challenges and requires tailored approaches to investigation, documentation, and settlement. In essence, the overview of insurance claims management reveals a system that is both operationally intensive and strategically significant. It is not merely about paying claims, but about doing so efficiently, fairly, and in compliance with the broader objectives of the insurance institution. Understanding this foundation is critical before examining the detailed processes and potential areas for dispute. Insurance claims process. The insurance claims process represents the operational backbone of the insurance business, translating contractual promises into actual financial compensation when a loss occurs. It is a sequential, structured workflow that begins with incident reporting and concludes with the claim's final settlement and closure. While the process may vary slightly across insurers and jurisdictions, The fundamental stages remain consistent and are designed to ensure that claims are handled efficiently and transparently, and in compliance with regulatory standards set by authorities such as the National Insurance Commission. Let us discuss the steps involved in the insurance claims process. 1. Claim notification. The claims process is initiated through what is commonly referred to as the first notice of loss. This stage occurs when the policyholder formally informs the insurer of a loss. The timeliness and accuracy of this notification are critical, as delays or incomplete information can complicate subsequent stages of the process. At this point, the insured provides preliminary details, including the nature of the loss, the date and location of the incident, and any immediate supporting evidence. In many cases, insurers have adopted digital channels to facilitate quicker reporting, including mobile applications, online portals, and call centers. The objective at this stage is to capture sufficient information to trigger the claims handling workflow while ensuring the policyholder receives guidance on next steps. 2. Claim registration and documentation. Following the notification, the insurer formally registers the claim in its system. This involves creating a claim file, assigning a unique claim number, and categorizing the claim by type and severity. The registration stage establishes the administrative foundation for the entire claims process. Documentation becomes central at this point. The insurer typically requires the policyholder to submit relevant documents, such as claim forms, proof of loss, photographs, police reports where applicable, medical reports for health claims, and repair estimates for property and motor claims. The completeness and authenticity of these documents are essential for ensuring an efficient evaluation process. Any deficiencies in documentation may result in delays or requests for additional information. 3. Claims investigation and loss assessment. Once the claim has been registered and the initial documentation has been received, the insurer conducts a detailed investigation to verify its validity. This stage is particularly critical in determining whether the loss falls within the scope of the policy coverage. The investigation process may involve appointing a loss or claims adjuster to assess the circumstances of the loss. The adjuster examines the cause of the incident, evaluates the extent of damage, and verifies the information provided by the policyholder. In more complex cases, forensic analysis or expert opinions may be required to establish causation and rule out fraudulent activity. This stage also involves assessing risk factors and identifying any inconsistencies or red flags. Effective investigation ensures that only legitimate claims are paid, thereby protecting the insurer from financial losses due to fraud or misrepresentation. 4. Claims evaluation and decision-making. Following the investigation, the insurer evaluates the claim based on the findings and the terms of the insurance policy. This stage involves a detailed analysis of coverage, including the interpretation of policy clauses, conditions, exclusions, and limits. The insurer determines whether the claim is admissible and, if so, calculates the amount payable. This calculation takes into account factors such as the sum insured, deductibles, depreciation, and any applicable policy limits. In liability claims, this stage may also involve determining the extent of the insured's legal responsibility to third parties. Decision-making at this stage must be both technically sound and legally defensible. Any ambiguity in policy interpretation can lead to disagreements, which may later evolve into claims disputes. Therefore, clarity, consistency, and adherence to policy wording are essential. 5. Claims settlement. The claims settlement stage represents the culmination of the evaluation process. If the claim is approved, the insurer compensates the policyholder or the relevant third party in accordance with the policy terms. Settlement may take different forms depending on the nature of the claim. In some cases, payment is made directly to the insured, while in others, such as motor or health insurance, the insurer may settle the claim directly with service providers, such as repairers or hospitals. The timing of settlement is critical, as delays can lead to customer dissatisfaction and potential regulatory sanctions. Where a claim is denied, the insurer must clearly communicate the reasons and provide justification based on the policy provisions. Transparent communication at this stage is essential to minimize misunderstandings and reduce the likelihood of disputes. 6. Claims closure. The final stage in the claims process is the closure of the claim file. This occurs after the claim has been fully settled or formally declined and all necessary documentation has been completed. Closure involves updating internal records, ensuring all financial transactions are properly recorded, and maintaining documentation for audit and regulatory purposes. Claims closure is not merely an administrative step, it also provides an opportunity for insurers to conduct post-claim analysis. Insights gained from closed claims can inform underwriting decisions, improve risk assessment models, and enhance future claims handling processes. The insurance claims process is a comprehensive and multi-stage system that requires coordination, technical expertise, and adherence to regulatory standards. Each stage plays a critical role in ensuring that claims are handled fairly and efficiently while safeguarding the insurer's financial integrity. Understanding this process provides a foundation for identifying where challenges and disputes may arise. In the next section, attention will shift to the common challenges in claims management, which often underlie claims disputes. Challenges in insurance claims management. Despite the structured nature of the insurance claims process, its practical execution is often fraught with complexities. Claims management operates at the intersection of customer expectations, contractual obligations, operational efficiency, and regulatory compliance. As a result, insurers frequently encounter a range of challenges that can hinder timely settlement, increase operational costs, and ultimately lead to disputes. Understanding these challenges is essential for improving claims outcomes and strengthening the overall credibility of the insurance system. 1. Fraudulent claims and moral hazard. One of the most persistent challenges in claims management is the prevalence of fraudulent claims. Fraud can take many forms, including exaggerated losses, staged incidents, falsified documentation, or deliberate misrepresentation of facts. This challenge is closely linked to the concept of moral hazard, in which the existence of insurance coverage may influence policyholders' behavior, potentially encouraging riskier actions or opportunistic claims. Detecting fraud requires a combination of investigative expertise, data analytics, and strong internal controls. However, excessive scrutiny can also delay legitimate claims, creating a delicate balance between fraud prevention and customer service. In markets where fraud detection systems are underdeveloped, insurers may experience significant financial leakage, which ultimately affects pricing and profitability. 2. Delays in claims processing. Timeliness is a critical performance indicator in claims management, yet delays remain a common issue. These delays can arise from multiple sources, including incomplete documentation, inefficient internal processes, inadequate staffing, or prolonged investigations. In some cases, delays are also caused by external dependencies, such as waiting for reports from third parties, such as police authorities, medical practitioners, or repairers. Prolonged claims processing not only frustrates policyholders but also increases the likelihood of disputes and complaints. From a regulatory perspective, failure to meet prescribed timelines, for example, those enforced by the National Insurance Commission, can expose insurers to sanctions and reputational damage. Therefore, improving process efficiency remains a central challenge for many insurance companies. 3. Inadequate documentation and information gaps. The quality and completeness of documentation play a pivotal role in the claims process. However, insurers often face challenges due to missing, inconsistent, or inaccurate information from policyholders. Inadequate documentation can delay claims assessment, complicate investigations, and increase the risk of incorrect decisions. In some instances, policyholders may not fully understand the documentation requirements or may lack access to necessary records, particularly in less formalized economic environments. These information gaps can lead to repeated requests for clarification, prolonging the claims cycle and negatively impacting customer experience. 4. Misinterpretation of policy terms and conditions. Insurance contracts are inherently technical documents, often containing complex language, exclusions, and conditions. Misinterpretation of these terms is a frequent source of conflict between insurers and policyholders. While insurers rely on precise policy wording to guide claims decisions, policyholders may have different expectations based on their understanding of coverage. This disconnect can result in disagreements over whether a claim is admissible or the extent of compensation payable. Ambiguities in policy language further exacerbate this issue, making it difficult to reach a consensus without escalation. Clear communication and simplified policy documentation are therefore critical, yet not always effectively implemented. 5. Customer dissatisfaction and expectations management. Claims management is the most emotionally charged aspect of the insurance life cycle, as it typically occurs during periods of loss or distress for the policyholder. As a result, customer expectations are often high, particularly regarding speed, transparency, and fairness. When these expectations are not met, dissatisfaction can quickly arise. Issues such as perceived delays, lack of communication, or disagreements over claim outcomes can erode trust and damage the insurer's reputation. In highly competitive markets, negative customer experiences can also lead to loss of business through policy cancellations and adverse word of mouth. Managing customer expectations requires not only efficient processes but also proactive communication and empathy, which are sometimes overlooked in operationally driven claims environments. 6. Regulatory and compliance pressures. Insurance claims management operates within a stringent regulatory framework designed to protect policyholders and ensure market stability. Regulatory bodies, such as the National Insurance Commission, impose requirements related to claims settlement timelines, transparency, and fair treatment of customers. While these regulations are necessary, they also introduce compliance challenges for insurers. Adhering to evolving regulatory standards requires continuous monitoring, staff training, and system upgrades. Non-compliance can result in financial penalties, legal consequences, and reputational harm. Balancing regulatory obligations with operational efficiency is therefore a key challenge in claims management. 7. Operational inefficiencies and legacy systems. Many insurance companies, particularly in emerging markets, continue to rely on manual processes or outdated legacy systems for claims handling. These systems may lack integration, automation, and real-time data capabilities, leading to inefficiencies and increased error rates. Operational bottlenecks can arise from redundant processes, poor workflow design, and limited use of technology. This not only slows down claims processing but also increases administrative costs. The transition to digital claims management systems and insurtech solutions presents opportunities for improvement, but implementation can be complex and resource-intensive. 8. Complexity of certain claims types. Not all claims are straightforward. Certain categories, particularly liability and large commercial claims, involve significant complexity. These claims may require extensive investigation, legal analysis, and coordination with multiple stakeholders. For example, liability claims often involve determining legal responsibility, which can be disputed and may ultimately require judicial intervention. Similarly, large property or industrial claims may involve technical assessments, valuation challenges, and negotiations over settlement amounts. Managing such complexity requires specialized expertise and can significantly extend the claims life cycle. The challenges in insurance claims management are multifaceted, spanning operational, technical, behavioral, and regulatory dimensions. These challenges not only affect the efficiency of claims handling but also drive claims disputes. Having examined these issues, the next section will focus on insurance claims disputes, exploring their causes, types, and implications for both insurers and policyholders. Insurance claims disputes. Insurance claims disputes are among the most sensitive and complex aspects of the insurance ecosystem. While the primary objective of insurance is to provide financial protection and peace of mind, disagreements often arise when compensation is expected. These disputes constrain the relationship between insurers and policyholders, undermine trust, and, in some cases, escalate into formal complaints or legal proceedings. At a fundamental level, claims disputes are not merely operational breakdowns, they are manifestations of deeper issues concerning expectations, the interpretation of contractual obligations, and the inherent tension between risk transfer and cost control. Understanding the nature and causes of these disputes is therefore critical for both insurers and policyholders. A claims dispute is a formal or informal disagreement between an insurer and a policyholder, beneficiary, or third party regarding the outcome of an insurance claim. This disagreement may arise at any stage of the claims process, but is most commonly associated with the decision to approve, deny, or quantify a claim. The dispute may involve questions such as whether the loss is covered under the policy, whether the insurer's assessment of the loss is accurate, or whether the claim has been handled within a reasonable time frame. In some cases, disputes may also involve third parties, particularly in liability insurance, where multiple interests and legal considerations come into play. From a risk management perspective, claims disputes are significant because they introduce legal, financial, and reputational risks. They can lead to increased administrative costs, regulatory scrutiny, and potential litigation, all of which can have long-term implications for the insurer. Categories of insurance disputes. An insurance dispute arises when an insurance company and the policyholder disagree on the terms of a settlement. A dispute can happen for many reasons, but the most common are claims denials and slow payouts. Insurance claims disputes can be categorized into two: 1. Dispute on the point of law or liability, and 2. Dispute on the quantum or amount of liability. Why claims disputes arise? Insurance claims disputes arise for several reasons, including 1. Divergence in expectations between insurer and policyholder. One of the most common causes of claims disputes is the gap between what policyholders expect and what the insurance policy actually provides. Policyholders often assume broader coverage than is explicitly stated in the contract, especially when policy terms are not fully understood at the point of purchase. When a claim is made, these expectations are tested, and any mismatch can quickly lead to disagreement. This divergence is often exacerbated by inadequate communication during the underwriting stage, where the scope and limitations of coverage may not have been clearly explained. As a result, the claims stage becomes the point at which these misunderstandings surface. 2. Ambiguity and complexity in policy wording. Insurance policies are legal contracts that frequently contain technical language, detailed clauses, and specific exclusions. While such precision is necessary for legal clarity, it can also create ambiguity for policyholders. Disputes often arise from differing interpretations of policy provisions, particularly regarding exclusions, conditions precedent, and coverage limits. In cases where policy wording is unclear or open to multiple interpretations, disagreements may require external resolution mechanisms, including mediation or judicial interpretation. This highlights the importance of clarity and simplicity in policy documentation. 3. Claim denial or partial settlement. A significant proportion of disputes stems from the insurer's decision to deny a claim or to settle it for an amount lower than expected by the policyholder. Claim denials may be based on factors such as non-disclosure, policy exclusions, lapse of coverage, or failure to meet specific conditions. Partial settlements, on the other hand, often lead to disputes over the valuation of loss. Policyholders may feel that the compensation offered does not adequately reflect the extent of their loss, while insurers rely on technical assessments, depreciation calculations, and policy limits to justify their decisions. This difference in perception frequently becomes a source of contention. 4. Delays in claims processing. Timeliness is a critical factor in claims management, and delays can significantly increase the likelihood of disputes. When claims are not processed within expected or regulated timeframes, policyholders may interpret the delay as inefficiency, lack of transparency, or even bad faith on the part of the insurer. Delays may result from internal inefficiencies, incomplete documentation, or prolonged investigations. However, regardless of the cause, the impact on customer perception can be substantial. Regulatory authorities such as the National Insurance Commission emphasize timely claims settlement, and failure to comply can escalate disputes into formal complaints. 5. Inadequate documentation and evidence. Another common source of disputes is insufficient or inappropriate documentation to support a claim. Insurers require detailed evidence to validate claims, but policyholders may struggle to provide the necessary information, either due to a lack of awareness or practical constraints. When documentation is incomplete or inconsistent, insurers may delay processing or reject the claim altogether. This can create frustration for policyholders, who may perceive the requirements as excessive or unreasonable, thereby triggering disputes. 6. Fraud suspicion and investigation. In situations where an insurer suspects fraud or misrepresentation, the claims process becomes more rigorous and time-consuming. While such scrutiny is necessary to protect the insurer from financial loss, it can also lead to disputes if the policyholder feels unfairly treated. Fraud investigations often involve detailed verification procedures, and in some cases, claims may be denied based on findings of misrepresentation or non-disclosure. These outcomes can be highly contentious, particularly when the policyholder disputes the insurer's conclusions. 7. Third-party involvement and liability issues. In certain types of insurance, particularly liability and motor insurance, claims may involve third parties. Determining liability in such cases can be complex and may depend on legal interpretations, evidence from multiple sources, and sometimes judicial decisions. Disputes can arise not only between the insurer and the policyholder but also among the various parties involved in the claim. This multi-party dynamic increases the complexity of resolution and often prolongs the dispute process. Insurance claims disputes are an inherent part of the insurance landscape, arising from a combination of contractual, operational, and behavioral factors. They reflect the challenges of aligning expectations, interpreting complex policy terms, and managing the realities of loss and compensation. Understanding why disputes arise provides a critical foundation for addressing them effectively. In the next section, the focus will shift to the types of insurance claims disputes, which will be categorized and examined in detail. Types of insurance claims disputes. Insurance claims disputes do not arise in a uniform manner, rather, they manifest in different forms depending on the nature of the disagreement between the insurer, the policyholder, and other involved parties. Classifying these disputes into distinct categories is important for analytical clarity, as each type has its own underlying causes, legal implications, and approaches to resolution. Broadly, claims disputes can be grouped into coverage, quantum, and liability disputes, as well as disputes arising from allegations of fraud or misrepresentation. Let us discuss types of insurance claims disputes. 1. Coverage disputes. Coverage disputes arise when there is a disagreement over whether a particular loss or event falls within the scope of the insurance policy. At the core of this type of dispute is the interpretation of policy terms, conditions, and exclusions. Insurance contracts are designed to clearly define what is covered and what is excluded. However, in practice, ambiguities in wording or differences in interpretation often lead to conflict. Policyholders may assume that certain risks are covered based on their understanding or expectations, while insurers rely strictly on the contractual language. Coverage disputes commonly arise when an insurer invokes an exclusion. For example, a property insurance claim arising from flood damage may be denied if flood risk is explicitly excluded from the policy. Similarly, claims may be rejected for non-compliance with policy conditions, such as failure to disclose material information or a breach of warranties. In many cases, the dispute is not merely about the existence of coverage but about how specific clauses should be interpreted. Where ambiguity exists, resolution may require external intervention, including regulatory guidance or judicial interpretation. 2. Quantum, amount, disputes. Quantum disputes, also referred to as valuation disputes, occur when both parties agree that a claim is valid but disagree on the amount payable. This type of dispute is particularly common in general insurance, where the assessment of loss involves estimation and professional judgment. The insurer relies on technical evaluations, depreciation models, and policy limits to determine the claim amount. In contrast, the policyholder may base their expectations on replacement costs or the perceived value of the damaged property. Differences in valuation methodologies often form the basis of quantum disputes. For instance, applying depreciation can significantly reduce the settlement amount, leading to dissatisfaction among the insured. Similarly, disagreements may arise over repair versus replacement decisions or the adequacy of cost estimates provided by contractors or service providers. These disputes require careful negotiation and, in some cases, the involvement of independent experts to arrive at a mutually acceptable valuation. 3. Liability disputes. Liability disputes are most prevalent in insurance classes that involve third-party claims, such as motor and liability insurance. In such cases, the central issue is determining who is legally responsible for the loss or damage. Unlike coverage or quantum disputes, which primarily involve the insurer and the insured, liability disputes often introduce additional parties, including third-party claimants, legal representatives, and sometimes multiple insurers. Establishing liability can be a complex process that depends on evidence, legal principles, and factual circumstances surrounding the incident. For example, in a motor accident claim, determining fault may require analysis of police reports, eyewitness accounts, and traffic laws. Disputes may arise when the insurer contests the extent of the insured's liability or when multiple parties share responsibility. In such situations, resolution may require legal proceedings or arbitration, particularly when significant financial exposure is involved. 4. Fraud and misrepresentation disputes. Disputes in this category arise when the insurer suspects that a claim is fraudulent or that the policyholder has engaged in misrepresentation or non-disclosure. Fraud can occur at different stages, including policy inception and claims submission. When fraud is suspected, insurers typically conduct detailed investigations to verify the authenticity of the claim. If evidence of fraud is established, the claim may be denied, and the policy itself may be voided. Fraud-related disputes are often highly contentious because they involve questions of integrity and intent. Policyholders may challenge the insurer's findings, arguing that any discrepancies were unintentional or the result of a misunderstanding rather than deliberate deception. The burden of proof in such cases can be significant, and disputes may escalate to legal proceedings if no agreement is reached. These disputes also carry reputational implications for both parties and require careful handling to ensure fairness and due process. 5. Procedural and delay-related disputes. In addition to substantive disagreements, disputes may also arise from procedural issues within the claims process. These include delays in claims handling, lack of communication, or perceived administrative inefficiencies. While such disputes may not initially involve disagreements over coverage or amount, they can escalate into more serious conflicts if not addressed promptly. Regulatory bodies, such as the National Insurance Commission, emphasize timely and transparent claims handling. Failure to meet these standards can lead to formal complaints and regulatory intervention. Policyholders may interpret delays or poor communication as evidence of unfair treatment, thereby increasing the likelihood of disputes. Effective process management and clear communication are therefore essential to minimizing this category of disputes. The classification of insurance claims disputes into coverage, quantum, liability, fraud-related, and procedural categories provides a structured framework for understanding the diverse nature of disagreements in claims management. Each type presents unique challenges and requires tailored approaches for resolution. Having examined the types of insurance claims disputes, let us discuss the principles and conditions of insurance claims processing. Principles and policy conditions on insurance claims. Insurance claims should be handled and processed in accordance with the policy terms and conditions. Some general principles and policy clauses apply to insurance claims. Most of the applicable principles and clauses are contained in the insurance policy, which embodies the contract terms and conditions. Here are the general principles and clauses applicable to insurance claims. 1. Notification condition. In order to protect their own position and perhaps that of the insured. 2. The insurers must have early notice of any event likely to give rise to a claim. Insurers need to know about a possible claim early so that they can start action to reduce the consequences. This is a standard policy condition that requires the insured or his legal representatives to a. Inform the insurer as soon as possible of any incident or event that may give rise to a claim, b. Forward immediately to the insurer all written documents, letters, claims, written summons and process, received on the incidents or accident, c. Advise the insurer in writing immediately of any pending or of an inquest. Where the claimant fails to comply with this condition, the insurer is within its rights to refuse to pay the claim if it is established that such a term was made a condition precedent to liability. 2. Proximate cause. The principle of proximate cause determines the actual cause of loss for the purpose of claim eligibility. In claims processing, insurers must identify whether the loss was caused by an insured peril or an excluded peril. The proximate cause is the dominant or most effective cause that sets in motion the chain of events leading to the loss. If the proximate cause is an insured risk, the claim is typically payable. If it is an excluded risk, the claim may be denied, even if other contributing factors are covered. 3. Reasonable care clause. The reasonable care clause requires the policyholder to take all reasonable steps to protect the vehicle from loss or damage and to keep it in a roadworthy condition. The law governing reasonable care clauses continues to evolve in response to changes in the risks and subject matter of insurance. The common feature seems to be that the insurer must prove a high level of reckless disregard for the property's safety before it can apply the policy condition to repudiate a claim. In addition, there should be a connection between any breach of condition and the loss. 4. Due observation condition. This condition requires the insured to observe and fulfill the policy's terms, provisions, and conditions. Failure to observe and comply with these terms may result in the insured forfeiting his or her right and benefits, partly or wholly, under the insurance contract. The court may have to decide whether the insured's failure to fulfill a particular obligation has jeopardized the insurer's position and thus entitled them to repudiate liability under the policy. For example, if an insured fails to report an accident to his insurers as quickly as they may have required, the court may have to decide whether the insurer's handling of the resultant claim has been prejudiced by the delay in reporting and if so, the extent to which the insurers are entitled to deny liability under their policy. 5. Insurable interest. Perhaps the one principle that does not appear explicitly in the policy wording is insurable interest. In order that any person can benefit from an insurance policy, they must show that they have an insurable interest in the subject matter. In other words, they must be able to demonstrate that the subject matter exists and that they will benefit from its continued well-being and will suffer financially by its loss. Insurable interest requires that the policyholder must have a legitimate financial or legal interest in the subject matter of insurance at both the time of policy inception and at the time of loss. In claims processing, this principle ensures that only parties who suffer a genuine financial loss are entitled to compensation. For example, in property insurance, a claim is valid only if the insured owns or has a financial stake in the damaged property. Without insurable interest, a claim becomes legally unenforceable. 6. Indemnity. The principle of indemnity is usually mentioned in the operative clause of the policy and may, in addition, be the subject of a definition. The principle of indemnity is central to general insurance claims. It states that the insured should be restored to the same financial position they occupied immediately before the loss occurred, without profiting from the claim. This principle ensures that insurance is a mechanism for compensation rather than gain. In practical claims processing, indemnity influences how losses are valued, particularly in property and motor insurance. Depreciation, market value, and replacement cost assessments are used to ensure that compensation reflects actual financial loss rather than perceived value. 7. Contribution. Contribution condition is a common condition under an indemnity insurance contract. Contribution is the right of the insurer to call upon other insurers who are similarly but not necessarily equally liable to the insured to share in the cost of an indemnity payment. The principle of contribution applies when multiple insurance policies cover the same risk. In claims processing, it ensures that the insured does not receive more than the actual loss by claiming full compensation from multiple insurers. Instead, each insurer contributes to the settlement in proportion to the extent of its coverage. This principle prevents overcompensation and maintains fairness within the insurance system. The following conditions must be fulfilled before the application of the contribution principle. 1. There must be 2 or more indemnity policies. 2. The policies must cover common interests. 3. The policies must cover the same subject matter. 4. The policies must cover a common peril that causes the loss. And 5. The policies must be in operation at the time of loss. The more obvious meaning concerns how 2 or more insurance policies can contribute to the same loss, ensuring that policyholders do not gain more than indemnity at the expense of insurers. Contribution can only follow indemnity and therefore does not apply to any benefits such as the personal accident benefits. The other usage of the term contribution relates to betterment. This occurs when, for instance, the insured vehicle's condition is better after the loss and repair than it was prior to the loss. 8. Control of claims and subrogation condition. Subrogation is another consequence of indemnity. In common law, the right to subrogation does not attach until indemnity has been provided, but at that time, the insurer can then stand in the shoes of the policyholder in exercising any rights of recovery that the policyholder had against the negligent party. Subrogation allows the insurer, after indemnifying the insured, to step into the insured's shoes and recover the loss from the third party responsible for the damage. This principle is particularly important in motor and liability insurance claims. In claims processing, subrogation ensures that the financial burden ultimately rests with the party at fault and helps insurers recover part of the claim payment, thereby improving loss recovery efficiency. The control of claims and subrogation goes hand in hand with the notification condition and gives the insurer the exclusive right to handle any claim to ensure proper handling. The condition also modifies the common law rule of subrogation by giving the insurer the right to prosecute in the insured's name for its own benefit, even before claim settlement. The condition also requires that no admission, offer, promise, payment or indemnity shall be made or given by or on behalf of the insured without the written consent of the insurance company. 9. Cancellation condition. Generally, both the insured and insurer can cancel an insurance contract. Here, the cancellation condition gives insurers the right to terminate their liability to indemnify the insured on relatively short notice. Insurers only, in exceptional circumstances, mainly for some reasons, exercise this, such as a. Adverse effect on consumer relations that may ensue, b. Consistently bad claim experience and no sign of improvement, c. Emergence of facts that make the risk different from what was not evident when the proposal form was completed, d. Insured guilty of a breach of good faith. 10. Fraud clause. In common law, any policy tainted with fraud is void. Contrast this with avoidable, which is the remedy available to the injured party where there is a breach of utmost good faith, for example, non-disclosure. A policy that is void in law is treated as though it never existed. Either party has rights or remedies under it, and the courts will not recognize its existence. There are two broad categories of insurance fraud. 1. Policyholder claim fraud. This includes fraud perpetrated by insurance policyholders, wholly or in collaboration with third parties, against insurance companies. 2. Intermediary fraud. This includes fraud perpetrated by intermediaries against the insurer, policyholders, customers, and beneficiaries. Should any claim be fraudulent, which will include gross exaggeration or be submitted with the use of forged documents, then the insurer would be within its right to refuse indemnity for that claim, to treat the policy as though it did not exist for the future and request reimbursement of any claims already paid. Because the policy is void at law, the policyholder has no right to reclaim the premiums paid. This doctrine is often backed by a policy condition that can only serve as a warning, bearing in mind that the very nature of fraud will render the policy ineffective and, therefore, the insurer cannot, in fact, impose the condition. 11. Admission of liability condition. All insurance policies contain a condition that the insured must not admit liability without the insurer's consent. It is important to recognize that insurers do not admit liability on behalf of the insured to a third party without the insured's prior consent. It would be unwise to make a categorical denial of liability before completing inquiries into the incident. This could precipitate a writ. If a repudiation of liability is the decided course of action, this must be after careful consideration of all evidence. All communications should be conducted without prejudice. There is now a greater requirement on defendant insurers to complete their liability investigations as early as possible. In fact, there is a need for greater openness on the part of both sides and for negotiated settlements, if at all possible. 12. Arbitration condition. The arbitration condition applies only in the event of a dispute over quantum, that is, the amount of the claim payable under a policy. The policy requires that disputes regarding the quantum, amount, of liability be referred to an arbitrator before any legal action can be taken against the insurer. 13. Documentation and proof of loss conditions. Policyholders are typically required to provide supporting evidence to substantiate their claims. This may include claim forms, police reports, medical records, invoices or photographs, depending on the type of insurance. These conditions ensure that claims are properly verified and reduce the risk of fraudulent or exaggerated claims. Inadequate documentation is one of the most common causes of claim delays and disputes. 14. Claims cooperation clause. The cooperation clause requires the insured to fully cooperate with the insurer during claims investigation. This includes providing additional information, attending interviews, and facilitating access to relevant records or property. Non-cooperation can significantly hinder the claims process and may result in the denial of the claim if it materially affects the insurer's ability to assess liability. 15. Exclusions and limitations. Insurance policies clearly define exclusions that specify events or circumstances not covered under the contract. In claims processing, exclusions play a decisive role in determining claim eligibility. Limitations may also apply in the form of caps on coverage amounts, deductibles, or waiting periods. These conditions ensure that the insurer's exposure is controlled and that premiums remain affordable. 16. Warranties and special conditions. Warranties are specific promises made by the insured that must be strictly complied with. These may relate to risk control measures such as security systems, fire safety standards, or vehicle maintenance requirements. In claims processing, a breach of warranty can lead to a claim being rejected, regardless of whether the breach directly caused the loss. This makes warranties particularly important in underwriting and claims validation. The principles of insurance and the policy conditions governing claims processing form the legal and operational backbone of the insurance claims system. While principles, such as utmost good faith, indemnity, and proximate cause ensure fairness and legal consistency, policy conditions define the practical rules that determine how claims are reported, investigated, and settled. A clear understanding of these frameworks is essential for insurers, policyholders, and intermediaries alike, as they collectively shape the outcome of every insurance claim and provide the foundation for effective dispute prevention and resolution. Having examined the principles and conditions of insurance claims processing, the next section focuses on claims dispute resolution mechanisms and explores methods for effectively managing and resolving them. Claims dispute resolution mechanisms. Insurance claims disputes, if not managed effectively, can escalate into costly and time-consuming conflicts that undermine trust and disrupt business operations. As a result, the insurance industry has developed a range of structured mechanisms to resolve disputes in a manner that is fair, efficient, and proportionate to the complexity of the issue. These mechanisms range from internal complaint handling processes to formal legal proceedings, and are often applied progressively, with an emphasis on resolving disputes at the earliest possible stage. The choice of resolution mechanism depends on several factors, including the nature of the dispute, the amount involved, the parties' willingness to cooperate, and the regulatory environment. In jurisdictions such as Nigeria, oversight by institutions like the National Insurance Commission ensures that dispute resolution processes adhere to principles of fairness, transparency, and consumer protection. Let us discuss the ways of resolving claims disputes. 1. Internal dispute resolution mechanisms. Insurance companies must have internal complaint handling systems. The first line of resolution for most insurance claim disputes lies within the insurer's internal complaint handling framework. Insurance companies typically maintain dedicated units to address customer grievances related to claims decisions, delays, or service quality. At this stage, the objective is to reassess the claim in light of the policyholder's concerns, review all relevant documentation, and determine whether the initial decision was appropriate. Internal resolution mechanisms are designed to be accessible, cost-effective, and relatively quick, making them the preferred starting point for dispute resolution. Internal mechanisms are effective in resolving straightforward disputes, particularly those arising from misunderstandings or minor procedural issues. However, their effectiveness may be limited when the dispute involves fundamental disagreements over policy interpretation or significant financial stakes. In such situations, policyholders may seek more independent avenues for resolution. 2. Negotiation. Negotiation is an informal, flexible approach to dispute resolution in which the insurer and the policyholder engage directly to reach a mutually acceptable outcome. This process may occur alongside or after internal complaint handling, and is often facilitated by claims officers, brokers, or legal representatives. The essence of negotiation lies in compromise, with both parties seeking to reconcile their positions without resorting to formal proceedings. It allows for creative solutions that may not strictly adhere to the original claim assessment but are acceptable to both sides. Negotiation is generally faster and less expensive than formal dispute resolution methods. It also preserves the relationship between the insurer and the policyholder, which is particularly important in long-term insurance contracts. However, successful negotiation depends on both parties' willingness to engage in good faith and make concessions where necessary. 3. Mediation. Mediation introduces a neutral third party, known as a mediator, who facilitates communication between the disputing parties and assists them in reaching a voluntary agreement. Unlike a judge or arbitrator, the mediator does not impose a decision but instead guides the parties toward a mutually acceptable resolution. The mediation process is structured yet flexible, allowing each party to present its perspective while the mediator identifies common ground and explores potential solutions. This approach is particularly useful in disputes where communication has broken down or where emotions are influencing the negotiation process. Mediation is valued for its confidentiality, speed, and cost-effectiveness. It also allows for more nuanced outcomes that can address the underlying interests of both parties, rather than focusing solely on legal rights. In many jurisdictions, regulators and industry bodies encourage mediation as an alternative to litigation, especially for consumer-related disputes. 4. Arbitration. Arbitration is a more formal dispute resolution mechanism in which an independent arbitrator or a panel of arbitrators is appointed to hear the case and make a binding decision. This process is typically governed by an arbitration agreement contained within the insurance policy or agreed upon by the parties after the dispute arises. Arbitration combines elements of both judicial and informal processes. It involves the presentation of evidence, legal arguments, and expert opinions, but is generally more flexible and less time-consuming than court proceedings. The decision rendered by an arbitrator, known as an award, is legally binding and enforceable. This provides a level of certainty and finality that is not present in negotiation or mediation. Arbitration is particularly suitable for complex disputes involving significant financial amounts or technical issues requiring expert evaluation. However, arbitration can be more costly than other alternative dispute resolution methods and may still require legal representation, increasing expenses for both parties. 5. Litigation. Litigation represents the most formal and adversarial form of dispute resolution. It involves submitting the dispute to a court of law, where a judge determines the outcome based on legal principles, evidence, and applicable statutes. Litigation is often considered a last resort due to its complexity, cost, and duration. However, it becomes necessary when other mechanisms have failed or when the dispute involves significant legal questions requiring authoritative interpretation. Court proceedings provide a definitive resolution to disputes and establish legal precedents that may influence future cases. However, litigation can be time-consuming and may damage the relationship between the insurer and the policyholder. It also exposes both parties to public scrutiny, as court decisions are typically part of the public record. In regulated markets, courts may also work in conjunction with regulatory frameworks to ensure that insurers adhere to standards set by authorities such as the National Insurance Commission, particularly in matters involving consumer protection. 6. Regulatory and ombudsman intervention. Regulatory bodies also play a critical role in dispute resolution. Institutions such as the National Insurance Commission may intervene in disputes, particularly where there are allegations of unfair treatment or non-compliance with industry standards. Regulators may provide complaint resolution platforms, issue directives to insurers, or impose sanctions where necessary. Their involvement adds an additional layer of oversight and accountability to the dispute resolution process. In some jurisdictions, independent ombudsman schemes are established to handle insurance disputes, particularly those involving individual policyholders. These bodies provide an accessible and impartial forum for resolving disputes without the need for formal litigation. Although the structure and availability of such services vary across countries, they represent an important component of consumer protection in the insurance sector. Claims dispute resolution mechanisms provide a comprehensive framework for addressing disagreements in the insurance industry, ranging from informal negotiation to formal litigation. Each mechanism has its own advantages and limitations, and the choice of approach depends on the nature and complexity of the dispute. An effective dispute resolution system not only resolves conflicts but also enhances trust, promotes fairness, and strengthens the overall integrity of the insurance market. In the next section, attention will shift to the regulatory and institutional framework, which underpins these mechanisms and ensures their proper functioning. Regulatory and institutional framework. The insurance industry operates within a well-defined regulatory and institutional framework designed to ensure stability, protect policyholders, and promote public confidence in the financial system. Claims management and dispute resolution, in particular, are subject to close oversight because they represent the point at which insurers fulfill their contractual obligations. Without effective regulation, there is a significant risk of unfair practices, delayed settlements, and erosion of trust in the insurance market. In the insurance sector, this framework is shaped by a combination of statutory provisions, regulatory guidelines, and institutional oversight mechanisms. Central to this system is the National Insurance Commission, which serves as the primary regulator of the insurance sector. Its role extends beyond supervision to include enforcement, consumer protection, and the promotion of best practices in claims handling. Role of national insurance regulators. National insurance regulators are central institutional actors in the governance of insurance markets. Their overarching mandate is to ensure that insurers operate in a financially sound, transparent, and fair manner while safeguarding policyholders' interests and maintaining systemic stability. In most jurisdictions, these responsibilities are carried out by specialized agencies such as the National Insurance Commission in Nigeria, which functions as both a prudential and market conduct supervisor within the insurance ecosystem. The role of regulators has evolved significantly in response to financial globalization, technological disruption, and emerging risks such as climate change and cyber threats. Contemporary regulatory frameworks integrate prudential supervision with consumer protection and market development objectives, reflecting a holistic approach to insurance sector governance. 1. Capital adequacy and solvency oversight. A fundamental responsibility of national insurance regulators is to ensure that insurers maintain adequate financial resources to meet their contractual obligations. This involves prescribing minimum capital requirements, solvency margins, and technical reserve standards. Regulators assess whether insurers can withstand adverse underwriting outcomes, investment losses, and catastrophic events without jeopardizing policyholder claims. Modern regulatory regimes increasingly adopt risk-based capital frameworks, in which capital requirements are aligned with each insurer's specific risk profile. This approach enhances the sensitivity of supervision to variations in underwriting, market, credit, and operational risk. 2. Asset liability management and investment supervision. Insurance regulators also monitor how insurers manage the relationship between their assets and liabilities. Given the long-term nature of many insurance obligations, mismatches in duration, currency, or liquidity can pose significant risks. Regulators, therefore, impose guidelines on investment practices, diversification, and admissible asset classes to ensure that insurers maintain prudent portfolios capable of supporting their liabilities. 3. Entry control and market access. National insurance regulators control market entry through a rigorous licensing process. Prospective insurers must demonstrate financial capacity, sound business models, and competent management before being granted authorization to operate. This gatekeeping function ensures that only credible and well-structured entities participate in the insurance market. The licensing process typically involves an evaluation of capital structure, ownership composition, governance frameworks, and operational readiness. Regulators may impose conditions or restrictions on licenses to mitigate identified risks. 4. Governance standards and fit and proper requirements. Regulators establish corporate governance standards to ensure that insurers are managed responsibly and ethically. This includes fit and proper assessments for directors and senior management, requirements for independent oversight, and the establishment of risk management and internal control systems. Strong governance structures are essential for preventing mismanagement, fraud, and excessive risk-taking. 5. Fair treatment of policyholders. Market conduct regulation focuses on how insurers design, market, and administer insurance products. Regulators require insurers to provide clear, accurate, and comprehensive information to consumers, thereby reducing information asymmetry and preventing mis-selling. Supervisory attention is given to policy documentation, disclosure of exclusions, premium pricing practices, and suitability of products for target markets. Regulators also monitor intermediaries to ensure that brokers and agents act in the best interests of clients. 6. Claims management and dispute resolution. Claims settlement is a critical touchpoint between insurers and policyholders. Regulators establish standards for timely, fair, and transparent claims handling processes. Delays, unjustified denials, or opaque procedures can erode trust in the insurance system and undermine market confidence. To address disputes, regulators often provide complaint resolution mechanisms, including mediation, arbitration, or ombudsman services. These mechanisms aim to resolve conflicts efficiently while minimizing the need for litigation. 7. Off-site surveillance and on-site inspections. Continuous supervision is essential for ensuring compliance with regulatory standards. National insurance regulators employ a combination of off-site monitoring and on-site inspections. Off-site surveillance involves analyzing periodic financial returns, actuarial valuations, and risk reports submitted by insurers. On-site inspections allow regulators to assess operational practices, governance structures, and internal controls directly. This dual approach enables regulators to detect early warning signals of financial distress or misconduct and to intervene proactively. 8. Enforcement powers and corrective actions. Regulators are endowed with enforcement powers to address non-compliance and protect the integrity of the insurance market. These powers include the ability to impose fines, issue directives, restrict business activities, and, in extreme cases, revoke licenses. Corrective actions may also involve requiring insurers to strengthen their capital base, improve governance structures, or restructure operations. Effective enforcement not only rectifies individual cases of non-compliance but also deters broader market misconduct. 9. Expansion of insurance penetration. In many emerging economies, national insurance regulators play a developmental role in increasing insurance penetration and promoting financial inclusion. This involves encouraging the introduction of affordable, accessible products, such as microinsurance, for low-income populations. Regulators may also collaborate with industry stakeholders to design frameworks that support innovation while maintaining consumer protection standards. 9. Promotion of innovation and digital transformation. The rise of insurtech has transformed the insurance landscape, introducing new distribution channels, underwriting models, and data analytics capabilities. Regulators are tasked with fostering innovation while managing associated risks. Regulatory sandboxes, innovation hubs, and adaptive regulatory frameworks are increasingly used to support technological advancement without compromising market stability. 10. Identification of systemic risks. Although insurers are traditionally viewed as less systemically risky than banks, large or interconnected insurance institutions can pose significant threats to financial stability. National insurance regulators, therefore, monitor systemic risks arising from interconnectedness, concentration of exposures, and cross-border operations. Particular attention is given to reinsurance dependencies, investment concentrations, and exposure to macroeconomic shocks. 11. Coordination with financial stability authorities. Insurance regulators often collaborate with central banks and other financial regulators to ensure a coordinated approach to systemic risk management. This is especially important in jurisdictions where financial conglomerates operate across banking, insurance, and capital markets. International coordination is also facilitated through organizations, such as the International Association of Insurance Supervisors, which develops global supervisory standards and promotes cross-border regulatory cooperation. 12. Policy formulation and standard setting. National insurance regulators are responsible for developing and updating the legal and regulatory frameworks governing the insurance sector. This includes drafting legislation, issuing guidelines, and establishing supervisory standards that reflect evolving market conditions and international best practices. Regulatory frameworks must balance the need for stability and consumer protection with the imperative to foster innovation and competitiveness. 13. Alignment with international standards. Globalization has increased the importance of aligning national regulatory frameworks with international standards. Compliance with frameworks such as the Insurance Core Principles enhances the credibility of domestic insurance markets and facilitates cross-border operations. Regulators, therefore, continuously review and adapt their policies to reflect global developments and emerging risks. 14. Enhancing insurance literacy. A well-informed public is essential for the effective functioning of the insurance market. National insurance regulators undertake educational initiatives to improve understanding of insurance products, rights, and obligations. These initiatives often involve public campaigns, workshops, and collaborations with educational institutions to promote financial literacy. 15. Building trust and confidence. Trust is a critical determinant of insurance uptake. By ensuring transparency, fairness, and accountability, regulators help build public confidence in the insurance sector. This, in turn, supports market growth and resilience. The role of national insurance regulators is comprehensive and dynamic, encompassing prudential supervision, market conduct oversight, consumer protection, and market development. Through effective regulation and supervision, these institutions ensure that insurers remain financially sound, operate fairly, and contribute to broader economic stability. As the insurance landscape continues to evolve, the importance of adaptive, risk-based, and forward-looking regulation becomes increasingly evident, reinforcing regulators' central role in shaping a resilient and inclusive insurance sector. Legal and statutory framework. The legal and statutory framework comprises insurance laws and contractual obligations, as well as the judicial system, and the enforcement of rights. Insurance laws and contractual obligations. The regulatory framework for claims management is underpinned by statutory laws that define the rights and obligations of both insurers and policyholders. These laws establish the legal basis for insurance contracts, including principles such as utmost good faith, insurable interest, and indemnity. Claims disputes often hinge on the interpretation of these legal principles, particularly in cases involving non-disclosure, misrepresentation, or breach of policy conditions. The legal framework, therefore, provides a reference point for resolving disputes and ensuring that decisions are consistent with established legal standards, judicial system, and enforcement of rights. The courts play a critical role in enforcing insurance contracts and resolving disputes that cannot be settled through alternative mechanisms. Judicial intervention provides a formal avenue for interpreting policy terms, determining liability, and enforcing claims settlements. Court decisions also contribute to the development of legal precedents, which can influence how similar disputes are handled in the future. This adds an additional layer of predictability and consistency to the claims management process. Institutional support structures. Institutional support structures include the roles of industry associations and professional bodies in capacity building. Role of industry associations. In addition to regulatory bodies, Industry associations contribute to the institutional framework by promoting professional standards and facilitating collaboration among insurers. Organizations such as the Nigerian Insurers Association play a role in developing guidelines, sharing best practices, and addressing industry-wide challenges. These associations often act as a bridge between regulators and market participants, helping to ensure that regulatory policies are effectively implemented, and that industry concerns are communicated to policymakers. Professional bodies, and capacity building. Professional institutions and training bodies also form part of the broader framework, supporting the development of technical expertise in claims management. Skilled professionals, including claims managers, loss adjusters, and risk analysts, are essential for maintaining high standards in claims handling. Continuous professional development ensures that practitioners remain up to date with evolving regulatory requirements, technological advancements, and emerging risks, thereby enhancing the overall quality of claims management. Consumer Protection Framework. The Consumer Protection Framework encompasses policyholder rights and protections, as well as complaint handling and redress mechanisms. Policyholder rights and protections. A central objective of the regulatory and institutional framework is to protect policyholders. This involves ensuring that customers are treated fairly, that their claims are handled transparently, and that they have access to effective dispute resolution mechanisms. Regulatory provisions often require insurers to establish internal complaint handling systems and provide clear channels for escalation when disputes arise. Policyholders are also entitled to receive adequate information about their rights and obligations under the policy. Complaint handling and redress mechanisms. Where policyholders are dissatisfied with the outcome of a claim, the framework provides avenues for redress. This may involve escalation to the regulator, engagement with independent dispute resolution bodies, or recourse to the courts. The National Insurance Commission's involvement in complaint resolution adds credibility to the process, and ensures that disputes are addressed fairly and impartially. This institutional support is essential for maintaining confidence in the insurance system. Emerging trends in regulatory oversight. Regulatory oversight in the insurance sector is undergoing a significant transformation driven by technological innovation, globalization, the interconnectedness of financial systems, and the increasing complexity of risks. What is often described as re-emerging trends reflects both the revival of traditional supervisory concerns, for example, solvency and consumer protection, and the adaptation of regulatory frameworks to contemporary challenges. Institutions such as the National Insurance Commission and global standard-setting bodies like the International Association of Insurance Supervisors are at the forefront of these developments, shaping policies that respond to evolving market dynamics. 1. Evolution from rules-based to risk-based frameworks. One of the most significant re-emerging trends is the shift from rigid rules-based regulation to more flexible risk-based and principles-based supervisory approaches. Traditional compliance-driven models are increasingly seen as insufficient in addressing the diverse and complex risk profiles of modern insurers. Regulators now focus on identifying, measuring, and managing risks specific to individual firms. Risk-based supervision enables regulators to allocate resources more efficiently by concentrating on institutions and activities that pose the greatest threats to financial stability and policyholder protection. This approach also enables a more forward-looking assessment of risks by incorporating stress testing and scenario analysis into supervisory processes. 2. Emphasis on enterprise risk management. Closely linked to risk-based supervision is the growing emphasis on enterprise risk management within insurance firms. Regulators now require insurers to adopt comprehensive risk management frameworks that integrate risk identification, assessment, mitigation, and reporting across all business functions. This trend reinforces the accountability of boards and senior management in maintaining robust risk governance structures. 3. Emergence of reg tech and sup tech. Technological innovation is reshaping regulatory oversight through the adoption of regulatory technology and supervisory technology. RegTech solutions enable insurers to automate compliance processes, enhance data accuracy, and improve reporting efficiency. At the same time, SupTech tools allow regulators to analyze large datasets, detect anomalies, and monitor market behavior in real time. The increasing use of data analytics, artificial intelligence, and machine learning is enhancing regulators' capacity to identify emerging risks and respond proactively. This technological integration represents a fundamental shift from reactive to predictive supervision. 4. Digitalization of insurance markets. The rapid growth of digital insurance platforms, online distribution channels, and insurtech startups has introduced new regulatory challenges. Regulators must address issues related to data privacy, cybersecurity, algorithmic transparency, and digital consumer protection. In markets such as Nigeria, digitalization is also linked to financial inclusion, making it a priority area for regulatory innovation. 5. Focus on conduct risk and fair treatment. Consumer protection has re-emerged as a central pillar of regulatory oversight, particularly in response to past instances of mis-selling and unfair treatment of policyholders. Regulators are increasingly focusing on conduct risk, which encompasses the behavior of insurers and intermediaries in their interactions with customers. This trend involves stricter disclosure requirements, enhanced transparency in product design, and greater scrutiny of sales practices. Regulators are also emphasizing the concept of treating customers fairly, which requires insurers to prioritize customer outcomes throughout the product life cycle. 6. Expansion of complaints and redress mechanisms. Regulatory frameworks are evolving to provide more accessible and efficient mechanisms for handling consumer complaints and disputes. This includes the establishment of ombudsman schemes, digital complaint platforms, and alternative dispute resolution mechanisms. These developments aim to strengthen trust in the insurance sector and ensure that policyholders have effective avenues for redress. 7. Incorporation of environmental, social, and governance (ESG) factors. A major re-emerging trend in regulatory oversight is the integration of environmental, social, and governance considerations into supervisory frameworks. Climate change, in particular, poses significant risks to the insurance industry through increased frequency and severity of natural disasters. Regulators are requiring insurers to assess and disclose their exposure to climate-related risks, incorporate sustainability considerations into investment decisions, and develop strategies for managing long-term environmental risks. This shift reflects a broader recognition of the role of insurance in supporting sustainable economic development. 8. Climate stress testing and scenario analysis. Supervisory authorities are increasingly conducting climate stress tests to assess insurers' resilience under various environmental scenarios. These exercises help identify vulnerabilities and inform policy interventions to enhance the sector's capacity to withstand climate-related shocks. 9. Increased international regulatory cooperation. The globalization of insurance markets has necessitated greater coordination among national regulators. Cross-border operations, multinational insurance groups, and global reinsurance arrangements require harmonized supervisory approaches to prevent regulatory arbitrage and ensure consistent standards. Organizations such as the International Association of Insurance Supervisors play a critical role in facilitating international cooperation, developing global standards, and promoting information sharing among regulators. 10. Supervisory colleges and group-wide supervision. Regulators are increasingly adopting group-wide supervision frameworks that consider the risks of entire insurance groups rather than individual entities. Supervisory colleges, comprising regulators from different jurisdictions, are used to coordinate oversight of multinational insurers. This approach enhances the effectiveness of supervision in a globalized market. 11. Identification of systemically important insurers. The global financial crisis highlighted the potential for large financial institutions, including insurers, to pose systemic risks. As a result, regulatory oversight has expanded to include identifying and monitoring systemically important insurers whose failure could have widespread economic consequences. Regulators are implementing additional supervisory measures for such institutions, including higher capital requirements, enhanced reporting obligations, and more intensive supervision. 12. Macroprudential surveillance. In addition to firm-level supervision, regulators are increasingly adopting a macroprudential perspective that considers risks to the financial system. This involves monitoring market trends, interconnectedness, and external shocks that could affect the stability of the insurance sector. 13. Encouraging innovation through controlled environments. To balance innovation with risk management, many regulators have introduced regulatory sandboxes that allow firms to test new products and business models in a controlled environment. These sandboxes provide regulatory flexibility while ensuring that consumer protection and financial stability are not compromised. This trend reflects a shift toward more collaborative and adaptive regulatory approaches that support technological advancement. 14. Adaptive and proportional regulation. Regulators are increasingly adopting proportional regulation, where supervisory requirements are tailored to the size, complexity, and risk profile of insurers. This approach ensures that smaller firms and startups are not unduly burdened by regulatory requirements while maintaining adequate safeguards. 15. Data governance and cybersecurity oversight. The increasing reliance on data in insurance operations has elevated the importance of data governance and protection. Regulators are introducing stricter requirements for data management, privacy, and security to address the risks associated with data breaches and misuse. Cybersecurity has become a critical area of regulatory focus, given the growing threat of cyber attacks on financial institutions. Regulators require insurers to implement robust cybersecurity frameworks, conduct regular risk assessments, and report incidents promptly. Re-emerging trends in regulatory oversight reflect a dynamic and evolving landscape shaped by technological innovation, global interconnectedness, and emerging risks. The transition toward risk-based supervision, the integration of digital technologies, the emphasis on consumer protection, and the incorporation of sustainability considerations all point to a more holistic and forward-looking approach to regulation. As regulators continue to adapt to these trends, their role in ensuring the resilience, fairness, and stability of the insurance sector becomes increasingly critical. Best practices in insurance claims management. Best practices in insurance claims management are the operational, technological, and governance principles insurers adopt to ensure claims are handled efficiently, fairly, and consistently. These practices are not merely administrative preferences, they are strategic imperatives that directly influence customer satisfaction, regulatory compliance, financial performance, and the overall credibility of the insurance institution. In a competitive and highly regulated environment, insurers that consistently apply best practices are better positioned to reduce disputes, improve settlement speed, and enhance trust in their brand. These practices also serve as preventive mechanisms against inefficiencies, fraud, and reputational risk. 1. Digital transformation and automation of claims processes. One of the most significant best practices in modern claims management is adopting digital technologies to streamline operations. Digital claims platforms allow insurers to automate key stages of the claims life cycle, including first notice of loss, documentation submission, assessment tracking, and settlement processing. Automation reduces human error, accelerates decision-making, and improves transparency by providing real-time updates to policyholders. It also enables insurers to handle high claim volumes more efficiently, particularly during catastrophic events such as floods or large-scale accidents. The integration of artificial intelligence and data analytics further enhances fraud detection and predictive risk assessment, making claims handling more proactive than reactive. 2. Transparency and clear communication. Transparency is a cornerstone of effective claims management. Policyholders are more likely to trust the insurance process when they are kept informed at every stage of their claim. Clear communication involves explaining policy terms in understandable language, providing regular updates on claim status, and ensuring that claim decisions are properly justified. Lack of communication is one of the leading causes of dissatisfaction and disputes. Therefore, insurers must prioritize proactive engagement with customers, particularly during delays or investigations. Transparency also includes providing clear reasons for claim approvals, partial settlements, or denials, which helps reduce misunderstandings and potential conflicts. 3. Efficient documentation and record management. Accurate and complete documentation is essential for effective claims handling. Best practice requires insurers to establish standardized documentation requirements and ensure that policyholders are guided through the submission process in a structured manner. Internally, insurers must maintain robust record management systems that allow for easy retrieval and verification of claim-related data. This not only supports faster decision-making but also ensures compliance with regulatory audit requirements. Proper documentation also plays a critical role in defending decisions in the event of disputes or legal challenges. 4. Strengthening fraud detection and risk controls. Fraud prevention is a key priority in claims management, as fraudulent claims can significantly impact insurer profitability and market stability. Best practices in this area involve using data analytics, pattern recognition tools, and cross-referencing systems to identify anomalies in claims behavior. Insurers also implement internal controls such as segregation of duties, multi-level approval processes, and independent loss assessments to reduce the risk of internal manipulation or external fraud. Importantly, fraud detection must be balanced with fairness to avoid wrongful denial of legitimate claims, which can damage customer trust and lead to disputes. 5. Customer-centric claims handling approach. A best practice approach to claims management places the customer at the center of the process. This means recognizing that claims often occur during periods of emotional and financial distress for policyholders, requiring empathy, responsiveness, and professionalism. Customer-centric claims handling involves simplifying processes, reducing unnecessary administrative burdens, and ensuring that policyholders receive timely assistance. It also involves training claims personnel to manage interactions with sensitivity while maintaining technical accuracy and adherence to policy terms. Ultimately, a positive claims experience strengthens customer loyalty and enhances long-term retention. 6. Compliance with regulatory standards. Compliance with regulatory requirements is not optional, it is a fundamental aspect of best practice in claims management. Insurers must ensure compliance with standards set by regulatory bodies such as the National Insurance Commission, particularly regarding claims settlement timelines, fairness, and transparency. Effective compliance requires continuous monitoring of internal processes, regular staff training, and periodic audits to ensure alignment with regulatory expectations. Insurers that embed compliance into their operational culture are better positioned to avoid sanctions and maintain strong regulatory relationships. 7. Continuous training and professional development. Claims management is a technical and evolving field that requires skilled professionals with up-to-date knowledge of insurance law, risk assessment, and emerging industry practices. Best practice, therefore, emphasizes continuous training and capacity building for claims personnel. This includes technical training on policy interpretation, negotiation skills, fraud detection techniques, and the use of digital claims systems. Well-trained staff are better equipped to make accurate decisions, manage disputes effectively, and deliver high-quality customer service. Best practices in insurance claims management are designed to create a system that is efficient, transparent, compliant, and customer-focused. When effectively implemented, these practices reduce operational inefficiencies, minimize disputes, and strengthen trust between insurers and policyholders. Having explored these best practices, the next section will focus on strategies to minimize claims disputes, examining practical measures to reduce conflict and improve resolution outcomes. Case studies and practical examples. Case studies provide a practical lens through which the theory of insurance claims management and dispute resolution can be understood in real-world terms. While frameworks, processes, and best practices establish the structure of claims handling, actual disputes often arise from nuanced, fact-specific situations involving human judgment, policy interpretation, and operational constraints. Examining practical examples helps to illustrate how claims disputes develop, how they are managed, and how they can be resolved effectively. We will be considering two realistic scenarios commonly encountered in insurance practice, one involving a motor insurance claim dispute, and the other a property insurance claim. Each case highlights the interaction among policy interpretation, claims assessment, and dispute resolution mechanisms. Case Study 1. Motor insurance claims dispute. In this scenario, a policyholder is involved in a road traffic accident and submits a claim under a comprehensive motor insurance policy. The insured vehicle sustains significant damage, and a third party is also involved, alleging injury and property damage. The policyholder promptly notifies the insurer and submits the required documentation, including a police report and photographs of the accident scene. Following the initial assessment, the insurer appoints a loss adjuster to investigate the incident. The adjuster's report indicates that the insured driver may have been partially responsible for the accident due to negligence, and also notes inconsistencies between the policyholder's account and witness statements. Based on this assessment, the insurer approves a partial settlement for vehicle repairs but declines to provide full liability coverage for third-party claims, citing contributory negligence and policy conditions. The policyholder disputes this decision, arguing that the insurer has underestimated the extent of coverage and misinterpreted the circumstances of the accident. The disagreement escalates into a formal claims dispute, with the policyholder seeking a full review of the decision. The insurer then initiates an internal review process, re-examining the adjuster's findings, policy wording, and supporting evidence. After further analysis, the insurer maintains its position but agrees to negotiate, with the insurance broker facilitating the process. Through negotiation, both parties reach a compromise whereby the insurer agrees to increase the settlement amount within certain policy limits, while the policyholder accepts partial liability. This case illustrates how liability disputes in motor insurance often arise from differing interpretations of the circumstances of the accident and the policy conditions, and how negotiation serves as an effective mechanism for resolution without resorting to litigation. Case Study 2. Property insurance claims dispute. In this second scenario, a commercial property owner experiences fire damage to a warehouse and files a claim under a property insurance policy. The insurer promptly registers the claim and initiates an investigation. During the assessment process, the loss adjuster determines that the fire was caused by an electrical fault, and also finds that the insured failed to fully disclose certain risk-related information at the time of policy inception. Based on this finding, the insurer raises concerns about material non-disclosure and significantly reduces the settlement amount, citing policy conditions related to disclosure and underwriting accuracy. The policyholder disputes this decision, arguing that the non-disclosure was unintentional, and that the insurer had sufficient opportunity to assess the risk during underwriting. The disagreement escalates into a formal dispute over both coverage and quantum. The insurer maintains that the breach of disclosure obligations justifies a reduction in liability, while the policyholder insists on full indemnification in proportion to the extent of physical loss. Given the complexity of the issue, the dispute proceeds to mediation. A neutral mediator reviews the case and facilitates discussions between both parties. During mediation, it became evident that although disclosure was incomplete, it did not materially affect the insurer's risk assessment. As a result, a revised settlement is agreed upon that is higher than the insurer's initial reduced offer but lower than the policyholder's original claim expectation. This case demonstrates how disclosure-related disputes can be resolved through structured alternative dispute resolution mechanisms, particularly where both legal interpretation and fairness considerations must be balanced. Lessons from practical scenarios. These case studies highlight that insurance claims disputes are rarely caused by a single factor. Instead, they often emerge from a combination of technical assessment, policy interpretation, human judgment, and communication gaps. They also demonstrate the importance of structured dispute resolution mechanisms, including negotiation and mediation, in achieving balanced outcomes. From a broader perspective, these examples reinforce the need for clear policy wording, robust claims investigation processes, and proactive communication with policyholders. They also underscore the role of professional judgment in claims management, where technical correctness must be balanced with fairness and customer relationship considerations. Practical case studies demonstrate that while claims disputes are inevitable in insurance practice, they are manageable when handled through structured processes and appropriate resolution mechanisms. The effectiveness of claims management is ultimately measured not only by the accuracy of decisions but also by the ability to resolve disagreements fairly and efficiently. This brings the discussion to its final stage, where the overall conclusions and key takeaways from the insurance claims management and dispute resolution framework will be summarized. Conclusion? This video has discussed insurance claims management and claims disputes. Here are the key takeaways. 1. Final reflection on insurance claims management and disputes. Insurance claims management is the most critical function in the insurance value chain, as it is the stage where contractual promises are converted into tangible financial outcomes. While underwriting and policy issuance define the expectations of coverage, the claims process determines whether those expectations are met in practice. As such, the effectiveness of claims management directly influences public confidence in the insurance industry. It has been established that claims management is not merely an administrative process but a complex system that integrates operational efficiency, legal interpretation, risk control, and customer service. When properly executed, it strengthens trust between insurers and policyholders, supports regulatory compliance, and enhances the financial stability of insurance institutions. 2. Key insights on claims disputes. It is also evident that claims disputes are an inherent feature of the insurance ecosystem. They arise not only from technical issues such as policy interpretation and valuation differences but also from behavioral and communication gaps between insurers and policyholders. These disputes are often shaped by expectations, perceptions of fairness, and the clarity of information provided throughout the insurance relationship. However, disputes are not necessarily negative when properly managed. They provide an opportunity for insurers to identify weaknesses in their processes, improve customer communication, and refine policy design. More importantly, they highlight the need for continuous alignment between contractual obligations and customer expectations. 3. Importance of structured resolution mechanisms. The discussion further demonstrates that the existence of structured dispute resolution mechanisms is essential to maintaining stability in the insurance market. Internal complaint systems, negotiation, mediation, arbitration, and litigation each play a distinct role in ensuring that disputes are resolved in a fair and orderly manner. The effectiveness of these mechanisms is strengthened by regulatory oversight from institutions such as the National Insurance Commission, which ensures that insurers adhere to principles of transparency, fairness, and timely claims settlement. Without such institutional support, disputes could escalate unchecked, undermining trust in the entire insurance system. 4. Strategic value of best practices in claims management. A key takeaway from the broader discussion is that many claims disputes are preventable. Best practices such as clear policy wording, proactive customer education, efficient claims processing, and the use of technology significantly reduce the likelihood of misunderstandings and disagreements. When insurers adopt a customer-centric and transparent approach to claims handling, they not only reduce disputes but also enhance customer loyalty and competitive advantage. In this sense, effective claims management becomes a strategic differentiator rather than a purely operational function. In conclusion, insurance claims management and dispute resolution are central to the credibility and sustainability of the insurance industry. The ability of insurers to manage claims efficiently, resolve disputes fairly, and maintain transparency throughout the process determines the level of trust they can build with policyholders and the broader public. Ultimately, a well-functioning claims system is defined not by the absence of disputes, but by its ability to resolve them effectively and fairly, reinforcing confidence in the insurance contract. I hope this video is educational and beneficial to you. Please post your comments below in the comments section. If this video has been educational and beneficial, please give it a thumbs up and share it with your friends. Thank you for seeing the Solomon Fadun, Risk Management of Everything videos. I love hearing from you. Please post your comments and questions below in the comments section. If you are new here, subscribe to the channel, Solomon Fadun, Risk Management of Everything's channel, and click the notification button to be notified when new videos are uploaded. Thank you.